All right, 8:35. We're bringing on the show here JC Parets, founder of Eagle Bay Capital. Also runs his research on Marketfy.com. Under the, well, he has several under Eagle Bay Solutions, including Dow 30. Takes a look at the commodities, a lot of
Hey, it is
international stuff too.
JC.
JC, good morning. You're live on pre-market. It's Kyle here, stepping in for Dennis, and obviously your favorite spooze trader, Joel O'Connor. What's going on, dude?
What's happening, boys? Hey, Kyle. Good to talk to you.
Good to talk to you too, buddy. We're just going over, got some good numbers here at 8:30 that just came out. Ton of earnings. I think we have over 300 reports coming out today. What's the world like on the charts with JC?
I got to tell you, in terms of equities, particularly U.S. stocks, I think there's an overall theme here that just really annoys me, and that's, a lot of our upside targets across the board have been hit. As you guys know, you guys get all my research, obviously. A lot of our targets have been hit. So, I kind of look at it almost as like a breadth indicator. I look at a lot of stocks, a lot of sectors, a lot of markets around the globe, and that's really the common theme, both domestic and overseas. And sorry about that, guys. And that really annoys me, especially as we approach overhead supply in the major averages. We're below resistance in the S&P 500 from the February highs. You can make a similar argument to the Russell 2000, the mid caps, the Dow Jones Industrial Average. So to me, I think a big theme here is patience and, let it come to us. Bigger picture, I think everything still is intact. Structurally, everything still looks fine. But from a tactical perspective, is this really where we want to be super aggressive? I think patience is probably a better bet.
So you're taking your foot a little bit off the gas here, but it's still on the gas. I know last time I spoke to you, you were pounding the table on healthcare, social media stocks. What charts do you like right now?
Yeah, and I'm glad that you brought that up. In the first quarter, healthcare was a big theme. So was social media, for that matter. On March the 20th, it was a Friday. Healthcare hit our upside target, which was it was a 161 extension of a major advance. That was our target. We got out, and we're fortunate to, because we haven't been anywhere near there since. And I think that that's part of a big of sector rotation. Biotechnology, healthcare. That was a big theme. Last year, well, the last few years for that matter, but particularly in the first quarter. And we're really seeing the rotation out of that space and into the more emerging markets, energy, materials. That's really been what's benefited from the weaker dollar. What we saw going into mid-March and on the show with you guys. I'm not sure if you listened in, Kyle, but with the other guys, I said that was it, guys. I've never seen such euphoria in terms of U.S. dollar bullishness. You guys know me. I'm an intermarket guy. I look at currencies and commodities and stocks, and I treat them all the same. No discrimination from my end. And never in my entire career has the media ever cared about what I think about the U.S. dollar. Never once. And I couldn't receive an email or a phone call from anybody in the media, whether it was the CNBCs and Foxes of the world, and even the online website. I could not get a single email or phone call without them asking me what I thought about the U.S. dollar. So anecdotally, it was to an extreme that I've never seen before. And the data, the sentiment data that we analyzed, also suggested the same thing. And not to mention that all of our upside targets in the U.S. dollar were hit in mid-March, and I was posting those charts, and I said, that was it, you paid this. And, not only did we fade U.S. dollars, we try to take advantage of what's going to benefit from a weaker dollar, not just from a currency perspective, but the theme that comes along with that. Like I said, emerging markets, base metal, energy, and then you're seeing it in the currency complex as well. Look at Canadian dollars absolutely exploding to the upside. Nothing makes me happier than to see sentiment unwind like that.
Okay, JC, I want to talk to you a little bit about Twitter earnings. You talked about, social media that did come off its high there. Twitter, first of all, you had the leak during the day, and boy, this stock is back in the 30s now. When you see this kind of action, a big action on the downside here, I mean, it's tempting if if you want to own this issue to, go out and get it. But what are you looking for here? A big landslide? I mean, what could be the good news? You don't have earnings coming out for another 3 months on the issue. Give us your technical take on Twitter.
Yeah, I think it's dead money. I think anybody trying to buy Twitter here is, for a lot of reasons. First of all, you talk about social media. I mean, this is the reason we use technical analysis. This is the reason that we look at supply and demand. As you guys know, it's pounding the table in social media. Month back, month and a half back, was a home run, absolutely exploded to the upside, hit our target. We got back up to those August, September highs, and, we rolled over from there. It should not be a surprise. There's clear overhead supply. Stocks, sectors, they hit your target. You need to acknowledge that. The market is a lot smarter than we are, guys. And, if an index like this, in this case, we're talking about the social media index, runs into that overhead supply, to think that we're just going to ignore that completely and pretend like that overhead supply is not there, I think it's irresponsible. So to say that, we're running into that overhead supply, I think it's normal. Now, you break it down to Twitter, I think that's dead money for a while. This thing's broken. I think if you're buying in here, I think you're trying to get cute for no reason. Sure, if you're a very, very, very short-term trader and you're going to get a bounce, honestly, I shouldn't say that because, sure, a 4-point bounce, I think you can even get more than that. I mean, that's a 10% move, actually. So I shouldn't say that that's not a big move. It is. But I think you got to fade that. From a structural perspective, this thing's broken. If you're a longer-term investor, if you're looking at this bigger, I think that you need to consider opportunity cost. There's a lot better things you could be in. So unless you're a very short-term trader, which I know a lot of listeners are, I think you need to fade strength. I think any strength, especially into the 40s, I think you got to sell that. I think this thing's broken. If you have any sort of intermediate or long-term time horizon, this is not a place you want to be.
I think it's kind of interesting, too, that, this thing IPO'd at the $40 level, hit 40, 45, bounced around, went up, made an all-time high a month later at 74, 73. You carry them down to 30 or 29.51 ahead of a lockup expiration, and here you are. You're back at $40. It's interesting that the street still hasn't decided the value of Twitter. What do you make of Facebook? I mean, they did beat by 2 cents. Pretty high expectations for the company, along with the social media. Kind of hanging here at the $80 level. What's your take on Facebook?
Structurally, I like it. It still looks fine, but tactically, here, it's still part of that theme, like the S&P 500, like Apple, like the Russell 2000, like mid caps. They're below that overhead supply from a couple of months ago. So, to be putting money to work here tactically right below overhead supply, to me, I don't think that makes any sense at all. Again, if you're a short-term trader, can you get a bounce back up towards the mid-80s? Sure. Depending on your time horizon and your risk tolerance, would that be a profitable trade? Of course. But if you have any sort of intermediate term time horizon, we're still below that overhead supply. To be buying below that, I think, is irresponsible.
All right, you talked about the dollar being weak right now, JC, but you also said it's not a time to get aggressive. Are you sitting on a lot of cash right now waiting for a couple of good charts, or are you fully deployed right now?
No, I actually have a ton of cash, more cash than we've had all year, in fact, for the simple reason that there's not a lot to like in terms of equities, for that matter. I think there's plenty of opportunities out there in the currency space and in commodities as well in the futures. But in terms of equities, man, it's tough. I got to tell you, but that theme of being below overhead supply in a lot of the major indexes, to me, really annoys me. And then in terms of the sectors and the individual stocks, a lot of them hit our short-term targets. So you got to take profits, feed the ducks, if you will. Once we did that and once we took those profits, I've been waiting to reallocate that cash in that similar theme. We haven't gotten those opportunities yet, so I'm being patient, and I don't think there's anything wrong with that. We're not long-only mutual fund managers that have to be deployed at all times. We're fortunate that we can sit tight, and like Ted Williams taught us, Kyle, you're an athlete. I know you, myself included. A guy like Ted Williams, The reason he had such high batting average throughout his career, that he was patient, wait for your pitch. And we have the ability as individuals, as money managers, to be in cash if we want to, deploy capital when we want to. We don't have to be 100% in like long-only mutual fund managers. We don't have to do that. We have the advantage that we can be patient. So why wouldn't we?
Amen. And I think a lot of traders can learn that too with that discipline. All right, going off your theme, I want to feed my ducks here in the chat room. Give me some tickers on the charts you're looking at with a weak dollar that you think our traders should take a look at.
Look at a name like Caterpillar. That has been an absolute monster for us. We came into the second quarter, really buying this stuff aggressively, and did it make our month. I love it. Would I be chasing it up here today and flipping my retirement account into Caterpillar? Probably not. But I think that you want to be. I think you want to be a buyer of weakness in a name like Caterpillar. A name like this really incorporates that whole theme that we just discussed. Emerging markets, global growth, energy, base metal, that whole world. That's Caterpillar. Look at a name like Freeport-McMoRan. Same thing. Base metal, copper related, emerging markets, really gotten slaughtered with a stronger dollar since last May. Again, I think that's a big theme that we want to be buying weakness. Those two names in particular, I think really incorporate that theme, that weaker dollar theme. And by the way, when you have such extreme sentiment unwinds, right? I've never seen so many dollar bulls in my entire life. I've never seen anything like it, like we saw in mid-March, and we obviously faded that. When they start to unwind, like we've been seeing, they can be very, very, very powerful. So I would say that theme is likely here to stay, and names like Caterpillar and Freeport, emerging markets as a group, energy, that whole theme, I think, is going to continue to do well in the second quarter. And we want to be buying weakness, not chasing strength, but buying weakness.
You've been in Russia, and I just pulled up the chart here in consolidation station here. What do you make of this? Wow, someone must be Putin up there selling in upper 1990s. A lot of resistance there. Very well-defined support, too. The last 5 trading days, lows at the 1950 level, 1950 to 20, trade the range. What you thinking here? You sticking with Russia?
No, we faded the strength, hit our target. This was another home run for us coming into the second quarter. Again, same theme. I mean, you look at a name like Russia, ton of exposure to energy and emerging markets for that matter, right? So, particularly the BRIC nations. But we hit our target. We have a downward sloping 200-day moving average. You want to be buying stock at a downward sloping 200-day moving average. I mean, you couldn't pay me enough to do that. I wouldn't be buying it. I would want to wait and see more consolidation.
Hey, JC, how do you talk about it hit our targets, we're fading into the strength. When you're getting into positions, how are you actually setting those targets?
Well, it depends. If we're, like, for example, Russell 2000 in the first quarter, I love the Russell 2000, as you guys know. I was very bullish the market going into February. That level, that 126 level, is the 161.8% Fibonacci extension of that fall correction. So that was our target, and that's why we faded that strength. Very similar with the healthcare, right? So we faded that towards the end of March. So in the case of stocks and indices making all-time highs, we don't have former support and resistance levels, so that's where we go to our old friend Leonardo Fibonacci, that although he's been dead for almost 1,000 years, he continues to make us all profitable. In terms of the mean reversion trade, like the Caterpillars and the Freeports and the Russias of the world, my whole idea coming into this was mean reversion. So I define the mean as the 200-period moving average. If we're looking at a daily chart from a tactical perspective, it's a 200K moving average. That's why we faded Russia as we got into that. I think Freeport and Caterpillar are still well below those levels. So that's why I'd rather be buying weakness in those names than trying to get cute with Russia. If you missed it, it's too late now. I think the other names that we discussed, the Caterpillars and the Freeports, I think you buy weakness and you fade that 200-day.
Now, when you fade into the strength, will you, as a rule of thumb, ever go short on the reversal?
Sometimes yes, sometimes no. In this case, I would not. I absolutely would not.
Okay, moving on, JC. We got some morning movers here. We'd like to get your take on Celgene, CELG. A little disappointment in the street. Biotechs have been under pressure lately. Celgene, any take on that? Trading down quite a bit here in the pre-market session.
Yeah, I think if you're buying biotech now, you missed it. This was you know, and I look at a name like Celgene, and I just rather look at the entire index as a group. And when you talk about the reasons we look at technical analysis, the reason that we study supply and demand, it's really, I think biotech is the perfect example. I mean, you cannot have a sector that is this well behaved than a biotech. I mean, it doesn't get cleaner than this, guys. On March the 20th, the day that we sold the Russell 2000 and healthcare by hitting our upside targets, on that day, it was a Friday. I won't forget it. And that's the day that biotech gapped the entire day. And it was just a slow, just meltdown the entire day on Friday. That was your entry point on the short side. I mean, it does not get cleaner than that. We bought a ton of put options on that Friday. And, biotech absolutely got destroyed. I mean, it behaved so perfectly. I mean, you cannot draw it up any better. We covered those puts that following Wednesday, call it the 26th, 25th, whatever it was. Beautiful sell-off. We covered it. And then we kind of like elevated higher ever since. Over the last month, we kind of just rallied back up to where? Right where the destruction started on March 20th. So you had another opportunity to short biotechs again last Friday. I mean, again, you can't make this stuff up. It does not get any cleaner. It was an easy short again last Friday. I was very vocal about it, and sure enough, we got destroyed. So I think it's broken. I think it's broken. I think it's probably going lower. I think if you want to sell any strength, I think there's a lot of people that are going to get stuck in this up here. I think biotechs continue to get destroyed. I don't think there's any reason to be buying this. I think the sector rotation here is evident. It doesn't get cleaner than this. I think the sector rotation is so clean. Money's rotating into the energies and the base metals, that whole complex, and it's coming out of the healthcares and biotechs. And I think if you're trying to buy biotechs here, other than maybe an intraday or a couple-day swing, if you have any sort of intermediate term time horizon and you're trying to buy biotechs now, I think you're in trouble.
Hey, we got education. We're going to get some education here from JC. What's the best way to learn the Fibonacci retracements, way to trade it from your perspective?
Well, I'm actually finishing my book now, so once that comes out, I suggest reading that. I have a nice little chapter on that. But in terms of how to trade Fibonacci, a guy like myself, I'm more of an extension guy than a retracement guy. I do utilize the Fibonacci retracements. I do look at them, but for me, it's the extensions. We're technicians, right? So the trend is your friend, and when you're in an uptrend or a downtrend for that matter, I like to look at, if we're in an uptrend, for example, and we retrace 10% or whatever it is within that uptrend, and then we resume the uptrend, I want to take that entire 10% retracement, and then once we exceed the previous highs, I want to take a 161.8% extension of that retracement to get our upside targets. To me, that's where the most value in Fibonacci comes in. We're seeing how much trouble the market has had after hitting all these Fibonacci extensions, a little over a month ago, and I can't say I'm surprised. In fact, I love seeing it. And if here's another great example. You guys and I were talking about Apple. You guys ask me about Apple every week. And I told you guys, 129, that was the level, right? And we were talking about this months ago, and I said, once we exceed the highs from November, we want to be buying Apple. This was in early February, and the target was 129, not just because that was the 161 Fibonacci extension from the November to January decline, but it was also the 161.8% Fibonacci extension from the 2012 decline. So when you have these Fibonacci extensions clustering together on multiple time frames and you decide to ignore that, again, getting back to irresponsibility, I think that's terrible. And, if you ignored that Fibonacci extension when it hit that target at the end of February, you've been sitting in in Apple for 2 months and not made a penny. So depending if you have a long-term time horizon, that might not seem like a big deal to you, not making any money for 2 months. But, for a guy like myself that gets judged on a quarterly basis to be sitting in something like Apple and not making a penny for 2 months, I can't justify that to my investors with a straight face. So, you have to respect these levels without question.
Don't force it. Don't force it. All right, JC, I got one more coming up for you before we head off. Taser had just tremendous earnings this morning, beating on the bottom and top by a significant amount. TASR, obviously a stock that's currently in the news again, as it has been over the last 12 or so months. Any thoughts on Taser?
Man, I was asked about this recently, and I was like, man, I didn't even know Taser still traded. But it does, and I guess it's in the news. I just, me, guys, I look at things from multiple time frames. I look at bigger picture charts to get a more, structural perspective, and then I break it down to shorter term charts, more tactically. What's it doing? Where's it at pre-market here?
Taser, let's take a look.
What's the bid and ask?
Oh man, I don't have the bid and ask up in front of me, but
I'll tell you right now.
The recent high of the move was 30.49.
Yeah.
It's up
a couple of points. It's up a couple of points. I'd be selling into this strength. We're running back into those those highs from back in 2004. So, to think that we're just going to break through that without acknowledging that former overhead supply, again, from a risk-reward standpoint, I think it's irresponsible to be buying Taser up here. I think you want to fade this strength, particularly from a structural perspective. Those highs were right around 33. We're right below that. If you're in it, you want to take profit. Would I be shorting it up here? Probably not. But I would absolutely not be buying this. No shot. Zero chance that I would touch this with a temple pole.
Tell us what you think. JC Parets, founder of Eagle Bay Capital, money manager, technician extraordinaire, joining us here on Benzinga's Pre-Market Prep. Thanks a lot, JC. We'll be back with Dennis next week.
Thanks again for having me, guys.